Most people think capital gain distributions are basically a bonus. Like, great, my fund made money and now I'm getting my share. But if you're nearing retirement with a meaningful portfolio, capital gain distributions can feel like less of a bonus and more like a tax bill that you didn't order. And the frustrating part is this: you can get hit with taxes from a fund even in a year when the fund's price barely moved or even went down. My name is Justin Kuntz, certified financial planner and managing director at Pacific Wealth Management. And in this video, I'm going to walk you through what capital gain distributions actually are, how they work, and why they happen. Because once you understand the mechanics, you can spot them coming and make smarter decisions before the damage is done. And we'll do it by following a situation that's painfully common for a ton of people. Meet Mark and Elena. They're both 62. They've done what they're supposed to do for decades. They've maxed out their retirement accounts, built a taxable brokerage account alongside it, and they kept things relatively simple with a handful of well-known mutual funds. They're not traders. They don't chase meme stocks. They're planners. Their retirement date is in sight. They're starting to imagine the first few years, the travel, the slower mornings, the feeling of finally being off the treadmill. And then in December, something happens that knocks them off balance. Their mutual fund sends a notice, a capital gain distribution. Mark reads it, shrugs, and says, okay, so we made money. Then their accountant tells them that their tax bill is going up in a meaningful way. Mark's immediate reaction is the one I hear all the time. Wait, why are we paying taxes when we didn't sell anything? Here's what we're going to cover, because this is where almost everyone gets blindsided. So let's start with the core issue. A capital gain distribution is not you selling your investment. It's your mutual fund selling investments inside the fund, realizing gains, and then being required to pass those gains through to you, the investor, because mutual funds are structured to distribute most realized gains each year. So even if you did nothing, the fund can still create taxable income in your brokerage account for you. That's the first mental shift. In Mark and Elena's mind, they owned a fund, but in reality, they owned a share of a moving machine, one that buys and sells all year long, whether they pay attention or not. So why does the fund sell things in the first place? Reason number one, investors leaving the fund. So this is the one that nobody really talks about at dinner, but it does matter in a lot of ways. Imagine a year where markets get shaky. Headlines are loud, people panic, and a bunch of investors in the mutual fund sell their shares to move to cash or to something else. The fund now has to come up with that cash to meet those redemption requirements. How does it do that? Well, it sells holdings. And if those holdings have gains, especially gains that built up over many, many years, those gains become realized. And then the fund passes them through to investors who stayed around. So Mark and Elena, who did the discipline thing and didn't panic, can end up paying the tax bill created by the people who did. Reason number two, the fund manager's trading decisions. So some funds trade a lot, some trade less. Some funds are essentially built to be tax efficient, and others are built to chase performance, rotate positions, and constantly improve the portfolio. In a retirement account, that trading doesn't create an immediate tax issue. But in a taxable account, it can be the difference between a quiet year and a surprise distribution that kicks you while you're trying to plan your next move. Reason number three, the fund rebalancing or changing strategy. A fund can shift what it owns at different points in time. It can replace positions, it can merge with another fund, it can change managers. Any of these can create internal selling and turnover. You don't feel it while it's happening, but you feel it when the distribution shows up. And now, for Mark and Elena, the next question is the obvious one. But if the fund is distributing gains, am I at least getting extra money out of this? Sometimes yes, but this is where the emotional whiplash happens. A distribution isn't a gift. It's more like your fund handing you a box and saying, here, this is yours, while quietly reducing what you already owned. Because when a mutual fund makes a distribution, the share price typically drops by roughly the amount of that distribution. So if you had a $50 share and it pays a $5 distribution, your share might now be around $45, and you received $5 in cash or reinvested shares. The total value might be similar immediately after, but now you've potentially created a taxable event. That's why some people look at their account and think, I didn't get richer, but I did get taxed, and they're not imagining it. Now let's get a little bit more specific, because not all distributions are taxed in the same way. There are generally two capital gain flavors. Long-term capital gain distributions, usually taxed at long-term capital gain rates, which can be lower than ordinary income rates depending on your income and situation. And short-term capital gain distributions, taxed as ordinary income, same category as wages and interest. Most investors assume that capital gains automatically means a favorable rate, but that's not necessarily true, not always at least. If your fund trades frequently and realizes short-term gains, you can get ordinary income tax treatment inside something that you thought was investing for the long run. Now, here's where this starts to matter more as retirement gets close. Mark and Elena aren't just thinking about returns anymore. They're thinking about control. They want to decide when they realize income. They want to decide when they sell. They want to decide how to keep taxes predictable. And capital gain distributions attack that control because they can show up regardless of what you do. So let's talk about that chain reaction. Mark and Elena have a plan in place. Mark wants to retire at 64, Elena at 63. They are going to live on a mix of cash flow from their brokerage account and some income from part-time consulting, while also delaying Social Security. They've built the plan carefully. Keep their taxable income in a certain range, avoid the big spikes, and let the portfolio do its job. Let it work. Then this distribution hits in December. This pushes their taxable income up, and suddenly, the year that was supposed to be clean and controlled becomes kind of messy, because taxes aren't just a single lever, but when income rises, multiple things can change all at once. You might move into a higher marginal tax bracket. You might pay higher capital gains tax rates on other sales that you did make throughout the year. Or you might make more of your Social Security taxable later on in life, depending on your income profile. You might also lose access to certain deductions or credits that phase out with different income levels. Or, even if you don't feel those immediately, the real problem is that it disrupts your plan. And the retirement plan is largely about managing ranges, keeping your income within certain lanes over time. Capital gains distributions are like a gust of wind that pushes you into another lane without warning. Now let's address the part that really bothers people. How can I owe taxes on a fund that didn't even do well this year? This happens more than you think, and it's one of the most important concepts in this entire video. Because your fund's performance for the year and its capital gain distribution are not the same thing, and a lot of times aren't even linked. So here's the simplest way to picture it. Mark and Elena have owned a mutual fund for years. Over that time, the fund accumulated a lot of unrealized gains. Stocks that went up, positions that appreciated, value that's just sitting there. Then, in a choppy year, the market drops. The fund's price is down for the year. But investors pull money out, so the fund has to sell holdings to raise cash, like in that example I talked about earlier. Those holdings might still have gains when measured over the last 5 or 10 years. So the fund realizes those older gains and distributes them to the investors. The result, Mark and Elena get a capital gain distribution in a year when the fund's value is flat or down year to date. And it feels like being asked to pay for a restaurant meal after you didn't even get to eat it. So you might be thinking, how do I avoid just mutual funds in general? Not necessarily. That's not necessarily the solution. Mutual funds can be perfectly fine tools, especially inside retirement accounts where distributions don't create current taxes for you. But in taxable brokerage account, you want to understand what you own and what the fund tends to do, or at least has historically done. Let's get practical. If you want fewer surprises, you need to reduce the sources of surprise. So here are the key moves that Mark and Elena start considering in a moment like this under guidance, and the same ones that tend to matter most when you've built a significant taxable portfolio and you're approaching the transition to retirement. First, know what you own and where you own it. The same fund in an IRA and in a brokerage account is not necessarily the same experience. In an IRA, Capital gain distributions don't create a current year tax bill. In a brokerage account, they do. So one of the simplest planning upgrades is asset location, putting tax inefficient holdings within a tax sheltered account when possible, and keeping more tax efficient holdings in taxable accounts. Second, pay attention to turnover and distribution history. Funds publish turnover ratios. They also publish distribution histories. So if a fund has a habit of paying large distributions, it's not random, it's part of its behavior that you can expect to continue. Mark and Elena thought they were buying diversification, but they were also buying a tax profile, whether they realized it or not. Third, be careful buying mutual funds late in the year. This is one of the easiest mistakes to make. Let's say it's November, you invest in a mutual fund. In December, the fund pays a big capital gain distribution based on gains that occurred throughout that year, or even before that, before you even owned it. You can end up paying taxes on gains that you didn't personally participate in. So this is why you'll sometimes hear the phrase, buying the distribution. It's not always avoidable, but it is oftentimes predictable. And many funds announce the estimates ahead of time so you can actually get a bit of a warning. Fourth, consider tax-efficient vehicles when appropriate. ETFs often have structural advantages that can reduce capital gain distributions because of the way creation and redemption works in kind. Not all ETFs are automatically tax efficient though, and not all mutual funds are tax inefficient. But structurally, ETFs often distribute fewer capital gains. This is one of those differences that starts to matter more as your taxable portfolio grows in value. Fifth, use tax loss harvesting strategically. This doesn't stop distributions from happening, but it can help offset gains when they do occur. If Mark and Eleanor receive a distribution that creates taxable gains, having harvested losses in other places in the portfolio can reduce their net taxable impact that year. But it has to be done carefully, with attention to wash sale rules and portfolio alignment, especially when you hold similar funds in multiple accounts. So here's the real takeaway. Mark and Elena didn't do anything wrong. They saved, they invested, they stayed disciplined. The problem is that as portfolios get larger and retirement gets closer, good enough investing becomes less about picking decent funds and more about controlling tax outcomes. Capital gain distributions are one of the most common ways investors lose that control because they're invisible right up until the point that they show up. So if you're looking at your brokerage account and thinking, I want retirement to feel simpler than this, the next step isn't guessing. The next step is getting clarity on three things: what holdings you have and are likely to distribute gains, where they're held and what it means for your taxes, and what changes, if any, actually improve your after-tax outcome without creating new risks. If you want help reviewing your portfolio for capital gain distributions and building a tax-aware retirement income plan, click the link in the description to book a free call with us. Because in the years leading up to retirement, avoiding one surprise tax year can be worth more than squeezing out a little extra performance. Thanks for watching.